So good afternoon, everybody. I'd like to welcome you all here today to Dublin for the International Capital Market Association Conference. It's a great pleasure for me to be invited to make the keynote address for this two-day event. As you are aware, financial services is an important sector in the Irish economy, and my officials and I are heavily involved in the continuing discussions and negotiations in Brussels in the area of financial services legislation. With that in mind, I want to take a few minutes to highlight a number of key issues at a European level that are important to Ireland and no doubt to the International Capital Markets Association members. I also want to use this opportunity to comment on Ireland's public finances. Finally, I'll make a few remarks about the banks in Ireland. Ireland has been a strong supporter of the Capital Markets Union since the very start. We see this as an important opportunity to develop deeper capital markets and thereby help improve growth in Europe. Today I just want to highlight a small number of important issues related to the Capital Markets Union. One of the frontrunners of the Capital Markets Union initiative is to update the rules which apply to the generation and issuance of prospectus. This will be achieved by way of EU regulation, which will seek to provide investors with the necessary information which will enable them to make informed investment decisions. The prospectus is the gateway to the capital markets, and therefore it is important that the prospectus rules achieve the right balance between investor protection, market integrity, and facilitating more issuances. We're happy with progress on the negotiations of the prospectus regulation in the European Council, and we are confident the final text will see a clear improvement in the rules. We want to see the updated rules facilitating more issuances by small and medium-sized enterprises. At the same time, we want to reduce unnecessary burdens on frequent issuers, for example, through a reformed disclosure regime for secondary issuances. Finally, we want the prospectus document to be more meaningful for investors, in particular retail investors. Another key objective of the Capital Markets Union initiative has been the aim to restart the securitization market in Europe. The intention here is to reopen key funding channels for economic activity in the European Union. The rejuvenation of the securitization market will benefit the real economy and all citizens of the European Union. Ireland welcomes the Council general approach that was achieved on the securitization package in December of 2015 and its aim of introducing simple, transparent and standardised securitisations. From an industry perspective, I fully appreciate the compliance challenge that stems from the raft of legislation introduced since the financial crisis. Clearly, very significant regulatory reform was necessary to address the problems that arose. Despite this, it is right that we now take stock and assess how this legislation works as a package. The call for evidence launched by the Commission under the Capital Markets Union initiative provides the opportunity to examine the coherence of EU financial service legislation as a whole. I think this exercise by the Commission is very worthwhile, and with 288 responses, a number of which came from Ireland, it is clear that it has given us much food for thought. The progress on implementing the Markets in Financial Instruments Directive, or MiFID, is also worth acknowledging. MiFID is a cornerstone of financial market legislation and will change the way European markets operate in the future, particularly non-equity markets. Its complexity and broad scope of application has proved very challenging for all concerned. However, the delivery of more transparent, efficient and safer financial markets will mean the challenge of implementing MiFID II will be well worthwhile. The asset management sector, you will be aware, in the asset management sector, you will be aware that Ireland is the principal domicile in Europe for those money market funds that are assessed on the basis of a constant net asset value. In fact, we have some 400 billion in assets under administration. Look behind that figure and you will see essential short-term credit for businesses across the European Union and further afield. You will also see an essential part of the success of the fund sector in Ireland. That is the reason that we have worked so vigorously for the last 3 years to find a European solution for enhanced regulation of money market funds. I believe that not only should this outcome be seen as a positive for Ireland, but also a win for the Capital Markets Union initiative in Europe. I'd like now to move from international developments to the situation at home and Ireland's financial position in particular. Underpinned by the improving economic environment, one of the main achievements of the last government was the dramatic improvement in Ireland's fiscal position. These hard-won gains provide a sustainable budgetary platform upon which funding for the provision of public services can be provided for in the years ahead. And the government has committed to continuing this important work. A clear indication of the enormous distance we have travelled can be gauged when you consider the deficit was 12.6% of GDP when we took office in 2011. For this year, it is currently projected to be 1.1%, and we're moving quickly towards a balanced budget both in nominal terms and in structural terms. Our debt to GDP ratio is now around the euro area average and trending downwards, a clear indicator of the tangible progress being made. Underlining these developments, the market reaction to our management of the public finances has been clear. Our cost of borrowing is currently close to historic lows, reflecting our continued economic and fiscal improvements, and also wider fixed income market developments. Irish bond yields are now trading in line with core European sovereign levels, having successfully decoupled from the Eurozone periphery. In 2011, the yield on 10-year Irish government paper reached 14%. Now it has remained steady through 2016, trading at below 1%. Only a few days ago, Moody's upgraded Ireland's long-term sovereign rating. This development, which sees Ireland restored to an A rating status with all the major rating agencies, is itself an acknowledgement of our continuing economic improvement. The endorsement will improve the National Treasury Management Agency's ability to market our bonds internationally, and hence the number and type of potential investors. This was driven by Moody's assessment of a continuing and material improvement in Ireland's economic recovery and our performance in reducing our public debt ratio over the past year. The second element underpinning the market reaction is confidence that fiscal policy will remain on a stable footing following the recent government formation, and that a broad political consensus exists on the need to continue with the improvements in the public finances. Moody's decision shows that they are confident that the programme for government published last week will reinforce this positive momentum, and this progress will continue under the new government. Ireland has spent the last 5 years rebuilding its reputation with international financial markets. Confidence once lost is not easily restored, but the government and our financial system has worked very hard to win back the faith of investors and market participants like yourselves. The new government also understands the importance of maintaining and building relationships with the financial markets. This is why I recently commented that there is nothing in the new programme for government that should concern our local banks. We need strong and viable banks if they are to support our recovery, particularly now that households and businesses are finding the confidence again to start borrowing and investing in their homes and businesses. We also do not intend to hold our banking investments for the long term. Quite the contrary. As I've said on a number of occasions, we intend to sell around 25% of AIB on the stock market when the timing is right, and we will also exit our shares in Bank of Ireland and Permanent TSB when this makes sense for the Irish taxpayers. Market conditions are not receptive to us doing anything in the near term. But as you all know, when market windows do present themselves, you need to have done your homework to be ready to take advantage of them. That is what the Department of Finance has been doing in recent months with the help of our independent financial advisor. Exiting our banking investment is the right thing to do. The Irish state didn't make these investments by choice, and every citizen has an interest in seeing these investments bear fruit. The disposal proceeds can help us further reduce the national debt and free up resources for other worthwhile uses. The provision in the new programme for government that we will not sell more than 25% of any bank by the end of 2018 is just a formal acknowledgement that we intend to exit these investments carefully and in a controlled manner, and it will not inhibit our freedom of action in any way. Before I conclude, I would like to make a few remarks about the credit unions. They play a vital role in the provision of financial services in Ireland. The Credit Union Advisory Committee advises me on a range of credit union matters, and I am pleased to announce that this afternoon, COAC, as they're known as, will publish two very interesting pieces of research. A survey of Irish credit unions, which over 100 credit unions participated in, and Visibility and Irish Credit Unions. The research gives information on the well-being of credit unions in Ireland, the competitive pressures they face, and their views on potential challenges going forward. The government recognises the important role of credit unions as a volunteer cooperative movement in this country. The government's priorities remain the protection of member savings, the financial stability of credit unions, and the sector overall, and it is determined to support a strengthening and growing credit union movement that can meet the financial needs of its members. The government recognises the importance of the financial services industry, both at home and abroad. The Capital Markets Union, the Capital Markets Union proposals are important, and we will continue to engage with them fully. Ireland has also worked hard to rebuild its reputation in the international markets, and this government will continue with this vital work as the fruits of our efforts are now there for all to see. We will continue to manage our finances in a prudent fashion, bringing our deficit down further and ensuring we continue to bring down and reduce our national debt. We will also continue to foster a sustainable recovery in our housing sector. I am sure that greater confidence and levels of activity will increase competition and choice for consumers and businesses alike. So again, I would like to thank you very much for inviting me here. I'd like also to thank you for listening to me this afternoon, and I hope you find the conference informative and instructive. And I hope you take some time out as well to enjoy one of the great European capitals, Dublin City. Thank you very much indeed.